Hello traders, welcome back to FS Page, your ultimate destination for mastering forex trading strategies. Today, we are diving deep into top-down analysis, the key to understanding market trends from a macro perspective all the way down to precise trade entries and exits. Have you ever felt lost in a market noise? In this video, I will show you how to break down the market into manageable pieces, from global economic forces to the finest price details. Stay with me until the end because I will reveal an advanced tip that top traders use to fine-tune their entries for maximum precision. Let's get started. 1. What is top-down analysis? Top-down analysis is a systematic approach to trading that starts by looking at the big picture, the macro level, and gradually drilling down to the micro details for precise trade setup. Macro level. This is where you assess global economic trends, geopolitical events, and overall market sentiment. Intermediate level. Next, you analyze daily or weekly charts to identify trends, chart patterns, and key support and resistance area. Micro level. Finally, you zoom into lower time frames to pinpoint the exact entry and exit points using detailed price action. This layered approach helps you trade in harmony with the broader market and minimizes risk by aligning your trades with the dominant trend. 2. Macro perspective. Let's start at the top, the macro level. It's all about understanding the global picture. Economic indicators. Look at GDP growth, inflation rates, unemployment data, and central bank policies. These factors influence currency value. Geopolitical event. Elections, trade wars, or any major news can cause shift in market sentiment. Market sentiment. Tools like the commitment of traders CTO report or currency strength meters give you insights into the overall mood of the market. For example, imagine a scenario where a major central bank hints at interest rate cuts. That could signal a weaker domestic currency affecting global currency pairs. By starting with this big picture, you can decide whether to adopt a bullish or bearish stance on the currency pair before even looking at the chart. What global event has had the biggest impact on your trading? Drop a comment below. I did love to hear your story. 3. Intermediate analysis, daily and weekly charts. Now that you understand the macro environment, let's move down to the intermediate level. This is where you analyze daily and weekly charts. Trend identification. Look for higher highs and higher low in an uptrend, or a lower highs and lower lows in a downtrend. Key levels. Identify significant support and resistance zones, chart patterns, and trend lines. Indicators. Use tools like moving averages or Fibonacci retracement levels to further validate your trend. Pro tip. Always look for confluence. Where multiple indicators point to same level, you have a stronger signal. Which indicator do you trust most on your daily charts? Let me know in the comment. 4. Micro analysis, pinpointing entry and exit points. Now, we zoom in into the micro level. The details that allow you to pinpoint your trade entries and exits. Price action. Watch for candlestick patterns like engulfing candles, hammers, or dojis that signal a potential move. Confirmation on lower time frames. If your daily chart is bullish, look for an ideal pullback on a 15 minutes or 1 hour chart before entering a long trade. Precision. Use lower time frame to refine your stop loss and take profit levels. Ensure your risk to reward ratio is optimal. Example, imagine the daily chart shows a bullish trend and on the 1 hour chart you see a pullback that forms a bullish engulfing candles at a key support level. That's your cue to enter with a tight stop loss just below the recent low. Stick around for the advanced tips on how to synchronize your multi-time frame analysis for even better entries. 5. Advanced tip: synchronizing multi-time frame analysis. Here is an advanced tip to further refine your strategy, synchronizing your multi-time frame analysis. Step 1. Confirm the overall trend on a daily or weekly chart. Step 2. Use the 4-hour chart to identify key immediate levels. Step 3. Pinpoint your entry and exit on a 15-minute or 1-hour chart based on price action signal. This approach ensures that every trade you take is supported by a consistent view across multiple time frames, reducing the chances of false signal. How do you combine different time frames in your analysis? Share your technique in the comment below. 6. Common pitfalls and how to avoid them. Even seasoned traders can stumble. Here are some common pitfalls in top-down analysis and how to avoid them. 1. Ignoring the macro picture. Always start with the global trends and economic conditions before diving into charts. 2. Overcomplicating your analysis. Focus on a few key indicators rather than cluttering your charts with too many signals. 3. Rushing your entries. Patience is crucial. Wait for clear confirmations across multiple time frames. 4. Poor risk management. Never risk more than 1 to 2% of your account on a single trade. Use proper stop loss and take profit levels. Pro tip: keep a detailed trading journal. Documenting your analysis helps identify what works and improves your strategy over time. And that's how you perform top-down analysis to master forex market trends, from the macro view to the micro details. By aligning your trades with the overall market trend, you will be well equipped to make smarter, more profitable decisions. What's your biggest takeaway from top-down analysis? Let me know in the comment. I'd love to hear your insights and experience. If you found this video helpful, please like, share, and subscribe to FS Page for more actionable trading strategies and tips. Namaste. Thanks for watching, and I will see you in the next video.